Thanks. Good morning, good afternoon, good evening, wherever you are. It's my pleasure to be the moderator of this session. And this is kindly to ask Nathalie Marins to hold her presentation. Nathalie is an anchor of the MoneyView projects. She is a coordinator of the BioSci Financial Stability Working Group. Nathalie, the floor is yours. You are going to have 15 minutes. Thank you.
Nathalie, I don't think we can hear you yet.
Yeah, now you should hear me. And you can see my screen also, right? Yes. So, well, hi, everyone. Thank you for joining the session. And well, this paper, I must say, is part of a bigger research from my PhD about the different monetary policy lemmas in economics discussions. Yet it only deals with what became the workhorse of Keynesian models for analyzing short-run aggregate phenomena known as the Mundum-Fleming. And although this model still receives a lot of criticisms from economists from different strands, it is still considered relevant or useful to analyze or illustrate current problems. And okay, my presentation will be a bit different than the previous paper. So in the sense that it's more a macro and not a micro or meso paper. And yes, well, and also it's a lot of more of modeling than, as Terry was saying, now it's not as empiric, but I'm looking forward to see what you have to say. But well, for monetary policy specifically, the result of the trilemma or the impossible trinity is a derivation of the Mundum-Fleming model. And it states that countries can only choose 2 out of 3 policy options to achieve 3 different policy goals. So free capital mobility, aiming financial integration with the rest of the world, a fixed exchange rate to achieve exchange rate stability, and monetary policy autonomy. And reading the literature, the point was that monetary policy autonomy or independence can mean different things. And it's clear when you read different papers, sometimes they are meaning different things. So monetary policy independence can be defined as freedom from external control to affect the policy instrument, either the interest rate or the money supply. And this is at the heart of the Mundum-Fleming framework, as I will explain next. But in contrast, as a policy goal of monetary policy can be said to be autonomous when it is free from external influence. So the goal can be impacted by external factors, as often occurs in a globalized economy. And this is the point of controversy of new Keynesian lemmas debate in the literature. But under those definitions, autonomy does not imply that the instrument will attain its intended effect, nor that the target will be achieved. For the later case, I think it's more useful to use the term monetary policy effectiveness. And so by highlighting these differences of instruments, goals, and effectiveness, one of the arguments of the paper is that using the term autonomy might be misleading and confusing to analyze policy space and constraints, especially in developing and emerging market economies, so countries that my research focus more on. So with this in mind, the paper critically assessed the Trilemma framework by presenting its origins during the 50s and the evolving hypothesis until the late 90s. And to do so, I start by presenting Mead's model that during the 50s highlighted the tools available to address the possible conflicts between a national policy of full employment, or what he called internal balance, and of equilibrium in the balance of payment, or external balance. And then after that, I go to the development of the Mundum-Fleming model in the 60s that popularized the monetary policy dilemma. And the last session, the paper presents the critiques of the model and suggests an alternative interpretation of the framework using some post-Keynesian critiques. So from policy options to the balance of payment. So before I continue, I think it's important to make a disclaimer here. The paper is not finished. I'm still working on many things, so it might sound a bit confusing, perhaps in some parts. And yes, every comment is very welcome. So now let's turn to Mead. So I started reading Mead's book and model because it served as an inspiration for the developments of other models during the 60s, which in turn served as the basis of the monetary policy trilemma. But nevertheless, instead of restrictions for policymaking, what Mead offered was a flexible tool for policymaking, taking the balance of payment into account. And his analysis suggested that countries could freely choose effective instruments for achieving their targets, as long as the Tilburgen rule was followed. So that is, there must be one instrument for each target. And even if assuming high commercial and financial integration, the instrument chosen by the monetary policy authority was the interest rate, which was autonomous and effective, either with fixed or flexible exchange rates. So that means that the money supply passively adapts itself, whatever the demand for money might be, at the constant interest rate. So also there was no a priori preference of foreign exchange regime, although he later argued that some sort of flexibility or an intermediate type of flexibility will be preferable than the extremes regimes. So in the paper, I tried to show that the trilemma consists of main two hypotheses that changed from Mead to Mondel-Fleming and explain the passage from monetary policy as a choice to monetary policy as a restriction when the exchange rate is fixed. So the first one is the monetarist assumption of the money supply as the proper instrument for monetary policy. Because with this choice, the interest rate is no longer under control of the central bank, but results from the relationship between internal and external funds. So at the end, it depends on the balance of payment result, which in turn means that it is partially dependent on external influence. The second hypothesis is the assumption that perfect capital mobility also means perfect capital substitutability. So making the balance of payment curve a flat line. So this also depends on the absence of the speculation that combined with the assumption of perfect capital mobility results in an immediate response of the exchange rate and the capital account to the interest rates. And yes, so in terms of the third curve, the S curve, it keeps the main hypothesis from Mead, fixed prices, and elasticity optimism. So that is the Marshall-Lerner condition holds. So it means that an exchange rate depreciation has a positive final effect on aggregate demand through its effects on exports. So I won't go into details of the adjustment mechanisms as it is well known, but the message is that monetary policy is an effective tool to improve aggregate demand in a flexible exchange rate system, given its impact on the exchange rate movements that improve the trade balance. While in a fixed exchange rate system, it only alters the level of international reserves with no effect on aggregate demand, precisely because the expansionary effect of the depreciation is not allowed. But from the trilemma, I think this graph and the table help to visualize the trilemma result. So in the graph, the initial movement from the LFM curve leads to a position of disequilibrium in the goods market in the lower quadrant. So here. So serialization to point B is possible, but to equilibrate the goods markets with the money and security markets, the exchange rate has also to return to initial point B. So in terms of the table 1, the expansionary monetary policy reduces government borrowing and increases its dishoarding, the money supply. So this leads to a reduction in the interest rates and capital outflows. And for the money and security markets to equilibrate in this condition, the private sector then has to alter its demand for money. But since there is no automatic mechanisms that will make it possible, the system remains inconsistent unless the interest rate returns to the previous levels. So speeding up a bit, I guess, so the same conclusion is present in the work of Fleming, but with his equations, the transmission mechanisms was clearer, and so the combination of both models is what resulted on the Mundell-Fleming model. But under the assumption of Mundell of the 63 paper, the message is that with a open capital account, monetary policy loses its capacity to define its policy instrument independently, and can only be effective through its effect on the exchange rate. So this mechanism was labeled by Abstral and Taylor as the monetary policy trilemma or the impossible trinity. So the Mundell-Fleming model and, oops, sorry, I got a bit nervous because we entered like a part that is more, that still needs more working. So the Mundell-Fleming model and the trilemma results, that is the case of perfect capital mobility, became the model of preference for both policy analysis and pedagogical purposes. And recent textbooks, such as the recent Blanchard book of 2021, still present a similar adjustments and the same conclusions as the Mundell-Fleming model for the open economy. And the argument for that is that this model is very simple and allows for a simple graphical representation. But yet I think that it can also be argued that there are other simple ways to represent a monetary policy space that is more realistic and dialogues better with emerging market and developing economies. So I wanted to discuss now a possible alternative way to analyze, or an alternative way that allows for more flexibility for policy making without disregarding that there can also be some constraints. So for that, I draw on previous attempts on post-Keynesian literature. So the first one is the endogenous money approach. So the first amendment made is going back to the use of the interest rate as the proper instrument of monetary policy. So because money is endogenous and demand-led, the central bank faces no constraint to sterilize foreign exchange inflows, but sterilization of foreign exchange outflows is limited by the foreign exchange reserves. So this means that the system is not inconsistent with sterilization, but it is limited to the foreign exchange reserves and external financial when a depreciation occurs. So the second amendment is using the intermediate case of the balance of payment curve, not because capital is not perfectly mobile, but because assets can have different risks, so they are not perfect substitute. So countries, securities and currencies can be associated to different types of risks. So even if we have perfect capital mobility, not having a perfect asset substitutability makes the balance of payment curve as the proper intermediate case for analysis. And although some remarks can be made about the elasticity optimism due to the pass-through effect, since the model is short-run in outlook, it seems fair to keep the ES curve as it was originally formulated from start. So going back to the balance of payment curve, another strand of the post-Keynesian literature makes a similar argument, yet it relates to the asymmetric insertion of emerging markets in developing economies in the international monetary system. But I think I'm running out of time. So I'm just going.
No, you still have 3 more minutes.
3 more minutes. Okay. Then the other criticisms that I want to adopt is the balance of payment constraint growth literature. So one criticism, another important criticism of the model Fleming model relates to the implicit assumption that a country can run a current account deficit indefinitely as the national interest rate is high enough. So this is especially problematic for countries at the bottom of the currency hierarchy that cannot borrow in their own currencies and thus suffer from currencies mismatches in their assets and liabilities. And this is especially stressed in this balance of payment literature, growth literature. So to make a general model to assess policy space and constraints, the present model adds to the new balance of payment curve and ELM curve these considerations. So besides the flat curve, the model includes a floor to the interest rates. So since in the current international monetary and financial system, some currencies are mostly used as a speculative asset class in international financial markets. Besides the interest rate differential, we have to include the liquidity and risk premiums affecting the demand for currencies and securities denominated in emerging market currencies. And of course, also some country risk and risk aversion and liquidity cycles parameters. And also, since the current account deficits will not be indefinitely financed, especially in emerging and developing economies, there can be a limit for attracting foreign finances. And this can be translated into an increasing country risk premium, so the parameter B. And that can also be subject to external risk aversion sentiment, so that's phi. So what the equations show is also that the LM floor is not fixed. So due to parameter beta and phi, it can vary according to the global financial liquidity cycle and the risk aversion sentiment, as well as with changes in external interest rates and of course exchange rates expectations. And as the standard case, we assume that the country under analysis does not issue the key currency and therefore has a deficit in the current account. And we use the parameter D, that is the ratio of external debt to export, as the indicator for measuring the capacity to repay the external debt. So in the second equation here, the parameter D max denotes the maximal level of debt, so this debt ratio, and R denotes the amount of foreign exchange reserve, and reflects the balance of payment constraint. That is, we can derive the maximum level of output consistent with this external financing. So it of course depends on exogenous parameters, such as how external agents define the maximum amount of debt, but also on the level of reserves and the exports and accumulated debt. So I would like to stop here because the model is not finished. I'm still thinking about its closure, the entire adjustment mechanisms, and seeing if it makes sense. But the idea is somehow to say that the balance of payment restriction and the floor to the interest rate depends on structural characteristics of each economy, as well as exogenous, external, and cyclical conditions. And therefore, although the choice of the exchange rate regime would not seem to affect them that much, yet although given the need to have a stable exchange rate in emerging market economies to maintain stability in output, and also because of currencies mixed matches, a fixed exchange, and also because a fixed exchange rate system is subject to an additional restriction. So it seems that an intermediate solution of an exchange regime also seems more appropriate. And of course, I think one other point is that restrictions does not necessarily mean lack of autonomy to choose targets and policy instrument. So I think I'll stop here. I extended myself, and thank you for listening, and I'm looking forward.
Thank you, Nathalie. It was a very, very interesting presentation. Perry, could you please kindly share your comments if you have any? You are muted, Perry.
Was I meant to be the discussant of this?
No. Kainaat is meant to be the discussant, but in case you have any comments to share.
Okay, so just off the top of my head, I think this is a very important entry point into thinking, and particularly it seems Nathalie is taking the point of view of the global South. I had just mentioned before the recording began that this is a sort of episode that in my book, it's chapter 7, which I call Among the Economists. Mundell was a student of Kindleberger's, and Kindleberger wrote him a letter to get him to the IMF, which is where he met Fleming. So this is part of the story, and they were fellow travelers in the attempt to prevent the breakdown of Bretton Woods. Fixed exchange rate people worried about the world of flexible exchange rates, and which made Kindleberger feel after 1971 that the dollar was no longer international money and it was a disaster. So this is I'm just placing this set of intellectual concerns in some historical context here and showing its importance. Yeah.
Thank you. This is a very interesting context, very important. Kainaat, I know that you are prepared as a discussant, but I think that due to the lack of time, maybe in case you have a question to Nathalie, maybe that could be very interesting if you could share. Thanks. And Nathalie, please reply.
So I don't have enough familiarity with monetary policy to really comment on this. But the one question I had was, would this model be extended to unconventional monetary policies?
Yes, but for that, it will have to be more complicated. I mean, I will just have to extend it a little bit more. And the objective of the model was to keep it as simple as possible. So as the model Fleming. And for unconventional monetary policy, perhaps going to some new Keynesian modeling, so more recent modeling will be best, I guess.
Thank you, Nathalie. I don't see any hands raised, so let me thank you again for your very nice presentation, and let me ask Dr. Kim Sengwu, who is a postdoctoral research fellow at the Graduate Institute Geneva, Switzerland. Sengwu's current research includes the regime competition of the two Koreas in the euro currency market in the city of London. And also he researches an alternative vision of the post-war international monetary system, UNCTAD and the reform of Bretton Woods. Seung-Woo, can you please hold your presentation?
Okay, thanks for the invitation. Well, this is my second participation of the Money View conference, and I used to be the only historian, so I think I'm doing my best to give you some comfortable time rather than diving into the complex themes of economics. So the presentation is all about how South Korea did not suffer 1982 debt crisis. It used to be among the most indebted country in the 1970s. It had pretty much massive amount of debt from the European market, but somehow it didn't suffer from any kind of 1982 crisis. Because if you think about the implication of 1982 in, say, Latin American countries, the introduction of a structural reform, implementation of neoliberal policies, the 1982 could be a pivotal moment in these countries. But South Korea didn't suffer. So the paper starts with a kind of very simple question: what happened? And let me start sort of a historical background. So in 1979, in internal reports titled Apocalypse Now, the Bank of England, who had not really supervised, but observed the euro currency market or euro dollar market from the 60s through 70s had a very pessimistic view. What if those countries with high level of indebtedness suddenly default? There were so many papers published, circulated among central banks. And as you can see in this small photo from the archival documents, you can clearly see South Korea is at number 3. And as we all know, there was debt crisis in 1982. But as I said, South Korea was not one of the victims of this financial mayhem. So there are a couple of scholars who said like why South Korea did not suffer. Jeffrey Sachs says that there was an exchange rate management and trade regime. South Korea was export-oriented industrialization country. Therefore, it was able to accrue foreign reserve, foreign currency out of exports. But given the high level of balance of payments deficit that South Korea chronically and continuously scored, well, it's quite questionable. The other one is the political economy. The Wu says, pretty simple, the United States backed it up because it's security importance given the Cold War politics. So she said, US stood as a foreign guarantor, which explains American banks' massive amount of lending operation to this less developed country. But by using archival documents, I kind of saw some different perspective. So whereas the previous literature pay attention to the geopolitics or the country by country, but they're missing very important thing, the euro currency market. They did not place this private international financial market at the center of analysis. Thankfully, archival documents, by analyzing them, we might be able to see some different aspects. So the paper is sort of 3 parts, and then I will add what I could call the money view. I'm not quite sure because Perry is here with us. So the first part is why South Korea entered into the European market, and then what was the Euro banks, the international banks in the European market understood the creditworthiness of South Korea as a virtuous debtor. And then instead of the international relation between South Korea and United States, I will suggest there were internal efforts by those technocrats, which well embraced the market-oriented policy assumption, which includes anti-inflation, low keeping wages, anti-inflation policy, which was pretty much designed, those policies were designed to appease, to satisfy the Euro banks, because they understood these factors were critical in evaluating creditworthiness, which in turn resulted in the lending operation decisions. So this is saying that instead, I mean, there certainly be American factor that US government sponsor the South Korean government, but at the same time, there were very important factors of technocrats in the making of South Korea and military government as a virtuous debtor. So I will look into the kind of the role of the technocrats, and then see how my paper can be blended into the money view. So I will start very fast because it's still very much background information. So let us start with the post-war growth mention. Like other non-Western or so-called global South, developing countries, economic growth was the key. The call for modernization, the call for independence, are all interlinked. It was also a source of legitimacy of some authoritarian regimes, like in the case of South Korea's military government. So the military government pursued a very ambitious, independent, heavy chemical industrialization, but there were huge problems that there was no money. South Korea, lack of domestic capital formation. Therefore, it depended on aid programs and grants from the United States and Japan. And there was also contingency of a Vietnam War boom. But there were tensions with the key allies. Under the Bretton Woods, US suffered a payments deficit, and there was a pressure that US should reduce its foreign spending. So part of the program to appease Western Europeans, there was a scheduled reduction in the aid program to developing world. Furthermore, the United States administration, Kennedy and LBJ, they did not agree with the heavy chemical industrialization plan by South Korean government. So they put conditions, or sometimes they frustrated the efforts by the South Korean government to raise money from international financial organizations such as the World Bank. So there were kind of trouble in getting official sources of capital. Therefore, South Korea turned to the euro currency market. It was a very logical, given the fact that there were alternatives available. So starting from its very first euro credit loan in June 1970, South Korea incrementally increased its borrowing activities in the euro currency market, but it did not, from the beginning, have a good start in the City of London. Think about it, City of London, you have to compete with US multinationals and Western European official institutions. South Korea, with full image of war, poverty, division, threat from the North Korea, I mean, still somewhat. So South Korea could not really compete in getting euro currency. So it turned to Asian dollar market, which was a regional market, regional euro dollar market in Asia. Then starting from the 1973, it entered into the City of London, the center for euro currency business. There were other factors. There were even Cold War competition with North Korea. Believe it or not, North Korea had enjoyed much better creditworthiness from international bank in the City of London in 1973, 1974, even 1975. South Korea was very concerned because in terms of rating competition, the successful flotation of euro bonds or euro loans by North Korea indicated that North Korea is a legitimate member in the world of finance. So South Korea pursued a financial diplomacy. But you couldn't really ask international banks that they should stop business with North Korea. This is suicidal. So what they try to do is, okay, we make more business ties with those international banks, then we leverage such customer relations. So in 1974, even after the Herstatt crisis, which resulted in the pretty much frozening of euro bonds activities, South Korea tried to float euro loans. And then, as we all know, 1974 oil crisis and globalization finance provided much venue through which South Korea can make their loans in the City of London and euro currency market. This is just a photo of North Korea's tombstone in 1973, and these are 3 tombstones for South Korea's euro loans, either euro bonds or euro currency or euro dollar, euro credit, sorry. Starting from 1975, South Korea literally plunged into the euro currency market, becoming the 3rd largest borrower, sovereign borrower in the euro currency market, as you can see. But there's striking differences between South Korea and other major developing countries with high level of indebtedness, which is low debt service ratio. As you can see, South Korea maintained close to 10, whereas the Philippines, even Thailand, had more than 10%. Well, the Latin American countries was around 30, even 40%. So what is the debt service ratio? Defined as a country's income in foreign currency that must go to the repayment of its existing medium and long-term foreign debt. It was understood, as the archival document says, a key factor in evaluating the creditworthiness of sovereign borrower by Euro banks. Pretty much a simple logic. if you show that your country can maintain a low level of service debt ratio, the Eurobanks will understand you as creditworthy. If you maintain a higher level, the Eurobanks will say, well, the country is more riskier than the others. And from 1975, 1976, South Korea was covered with the scandals. Threat from North Korea still exists. There were very notorious axe-murder case where the North Korean soldiers, killed U.S. soldiers at the border at DMZ, and there was a trouble between United States and South Korea because Americans problematized the South Korea's humanitarian issues. Also in 1976, there was Korean Gate, through which the South Korean government lobbied the US congressman. So South Korea's color with a very bad reputation in terms of international politics, especially there was a deterioration of a ally relation between the South Korea and the United States. But South Korea would successfully continue to raise money from the euro currency market, mostly euro dollars. It's denominated in US dollars. So by 1976, there was a comment by foreign bankers in Seoul saying that the South Korea shows remarkable efficiency displayed by the Korean authorities in the administration of their foreign debt and their strict compliance with external obligations. How could such positive notion came out? Those old bankers pointed out the role of technocrats, those elite civil officials under the military government. They were not part of the military junta. But they were brain trust of economic planning of South Korea and shared educational background. They're from same university. And they enter in civil servant job after the examination. And when they became, they came back with an American PhD. Most likely they observed monetary stability, either from Stanford or from Chicago or Missouri University. And upon their return to the government position at the Economic Planning Board, they tried to implement the market-friendly assumption based on the price stability and comparative advantage. But such a policy assumption contested that of the protectionist assumption of grossmanship by the military junta, even including the dictator, the President Park. But they could survive because of their, they were really good at managing the debt, and they had a really highly regarded by not only Eurobanks, international banks, but also the IMF. For example, Nam Dagu, who used to be a minister of the Economic Planning Board, was regarded as one of the foremost capable finance experts in Asia. And his policy orientation towards anti-inflation price stabilization was highly regarded. And there were troubles, challenges, internal conflicts between those elites, civil servants, and military juntas within the same military government. In 1979, the economic stabilization policy vindicated the victory of those technocrats, which also imply the new orientation out of the contestation, that the international commitment of a stabilization, price, and low wages are much more preferred to the domestic considerations of wages and employment. And after 1979, there's a turbulent moment in South Korea. The dictator was assassinated, and soon another military junta succeeded their coup and established another military government. Foreign bankers in Seoul had a position of wait and see, but they relieved when they realized, when they saw the announcement by the new military government that the new cabinet will include those former technocrats. Kim Jae, chief economic advisor to the president, Nam Da-gu, the one introducing the previous slide, as acting prime minister. The funny thing, not funny thing, but the thing, important thing about this new military government is that the new president, the President John, totally augmented all the issues about economic policy to these technocrats. So their policy assumptions, market-friendly assumptions, well implemented, even after the assassination of President Park. So there was a kind of coherence in terms of a policy assumption, at least with regard to the managing external debt. So in 1981, South Korea's debt service was understood, easily manageable with the highest credit rating. This is the graph you can see. Korea scores is August 1982. So 1981, at the dawn of the debt crisis, South Korea maintains pretty much low, the lowest debt service ratio among the key major borrowing countries. So this is kind of pretty much a paper. It's a history paper, but since the invitation, I've been thinking about how I can link the kind of case study of South Korea with the money view. As far as I'm concerned, and I understand, the money view provides a very interesting is the hierarchy of currency, which puts the US dollar at the top. So this kind of a case study of South Korea reminds of the kindergarten. The euro-dollar market is a dollar market, to be sure, but it is a European. Well, I would say it was Asian as well, because there was an Asian dollar market. Kinderberger did not really know, because the Asian market was really in the beginning in 1969. The subject to the banking regulations of no country and to no inspiration, evolved like the Topsy to a considerable extent by accident, and not the result of planning by economists. It represents a flexible, supple instrument for the provision of liquidity and for reducing it, an instrument which is politic-free, free of national politics. South Korea maintained high-level creditworthiness despite the troubles with the key allies of the United States, who is also, interestingly, issuer of dollar. But the dollar, when it mutated into euro dollar, it became something different. To paraphrase from Kinderberg, politic-free. So South Korea much needed money, as the previous, the first presentation says there's a kind of a hierarchy of currency. South Korea much needed the US dollar, but the US dollar didn't come directly from the American government or American person, but it came from the euro currency market via euro banks. And interesting, it was free from politics. This kind of gives you kind of an interesting story about the kind of a ambivalence of dollar, I think. And the fact that the dollar was available through euro currency market, I think is sort of a making of a dollar hegemony by concept, not coercion. And also, it is interesting to see how the goal of satisfying the demand or criteria from the euro currency market had an interesting political implication upon the South Korea. In other words, the neoliberal turn, the early neoliberal turn of South Korea can be explained by those issues of external debt. And at the heart of it, there lies the euro currency market. Yeah, I think I should wrap it up. Thanks for your attention.
Thank you very much for your presentation. Nathalie, can you please discuss very quick, if it's possible?
Yes, thank you for sending me your paper, Seung. I think it's really interesting You had very interesting insights about the role of bankers. I really liked your presentation. I think your presentation is clearer than the text. So my suggestion will be to just revise and maybe write it as if you are presenting right now, because it got much clearer to me while the presentation. But I really like your political economy approach of financial integration, and I learned a lot reading it. And I was curious about some things, and I think that needed more clarification. It was a bit clearer now with your presentation, but I used to read that even as commercial lending came to play a more important role in the 70s, and as you presented here, it's the consequence of the debt ratio maintaining it so low, though combined with the role of the elite in South Korea. But the surge in official lending in the years preceding and following the 80s international debt crisis appear to have also had an important role in maintaining the solvency of South Korea, not just new loans, but to maintain the solvency. So it was not clear to me the role they played in your paper, because now I understand that you think the fiscalist approach or the stability policy were more important. But yeah, I would like to hear a bit more for that. And also in the paper, although I agree that maintaining low wages might be unsustainable for growth as a growth perspective, if the economy is assumed to be demand-led, I was curious to know if that is also what is in your hand when you mind that this policy was not sustainable. So what do you mean by an unsustainable policy? And so to finish, the last question is, you explained that the increase in the euro-dollar debt was intended to help finance an export-led strategy after a failed import substitution strategy. So maybe can you explain how and why this strategy failed? So I mean, it was lack of finance that became available after that with the euro market. I mean, that was not so clear. But yes, I think that were my comments and questions. Thank you, Seung.
Thank you, Nathalie. Seung Woo,
Yeah.
you want to reply?
Sorry, I didn't really get the core of the first question, but so in the meantime, let me answer you the question number 2. Sustainability. I was thinking about the kind of a trade-off out of the neoliberal term, which includes this price stabilization and the low wage. I think it was pretty much supplemented by the existence of authoritarian regime. So I pretty much shed lights on the tension between the technocrats and military junta. But in order to implement successfully those price stabilization and anti-inflation policy, the authoritarian regime was much needed for that process. So it was kind of circular. And then through the 1980s, I haven't really explored into that part, but it became less sustainable because of the growth of the middle class, growth of the political movements. The 80s turned into totally different pages in the political history of South Korea. Pretty much democratization movements really were into the action, and then they were kind of a middle class and working class really turning back on those policies of the military government. And you were saying the import substitution, right? For the third question. Well, why did it fail? Pretty simple. The government was not ready for it. And there were so much internal issues like corruption. And then even with the euro dollar, there's kind of funny, interesting, when South Korea first euro dollar loan in 1970, they get the money, but government had no idea how to use it. So they just decide to distribute to the big business. So that even the euro currency, those dollars, became pretty much ineffective.
Okay, thank you. Paddy, you have also a question or comment, please.
Yes, this is a very interesting paper, and particularly the connection you make with the money view and with Kindleberger, I think is apt. Let me even build on that a little bit and point out some more aspects of that. Remember that this is really a story about the origins of the offshore dollar market. And that's sort of what you're saying there. But of course, that's what happened in the 70s. Kindleberger himself thought that most of this lending should be happening in New York, right? That New York should be the world center as London had been, and that this was destroyed by American politics. That really and stupid economists who saw this as capital outflow or something, and so it was pushed offshore. And now, so this is an example of the growth, and it's extremely important that this is beginning before the oil crisis, right? That a lot of the people think the Eurodollar market grew to recycle the profits from OPEC. It was in fact growing before that. Okay, it was in place already, and that's what you're showing with this particular case of Korea. That's the first point. The second point is to appreciate that the period you're talking about is the flexible exchange rate period. Okay, that international capital flows survived a flexible exchange rate system, which again, Kindleberger didn't expect. He thought that just as in the 30s, the breakdown of the international monetary system would lead to a ceasing capital flows. And in fact, that's to connect with Nathalie's paper, that's what the flexible exchange rate people wanted, right? They wanted monetary autonomy, and it didn't happen. Capital flows continued anyway, even with flexible exchange rates. And so it's remarkable. It's a remarkable instance there, and and your archival work to dig all of that out is really very fascinating episode. So I thank you very much. Oh, I see you just gave me the reference. It was the Banca Nazionale del Lavoro quarterly review. So whenever Kindleberger wanted to write something that was his own point of view, he always published it there because he could never publish this stuff in American journals. So that's a very good source. I think I read that. It's in a later collection. It's in a later collection. Yeah. I hadn't appreciated that he was thinking of that even in 1969. So that's before the abdication of 71, before Nixon devalues the dollar. But he is seeing the Eurodollar system as a substitute for the New York capital market. And he always thought that the global capital market was really key for the global South. And so he was a big fan of the Eurodollar market. You're quite right to point that out. Yeah.
There was another article where he used the term lingua franca when it comes to the Eurodollar. So there are kind of interesting moments. Yeah, and if I may add what you have discussed before the whole session begin, I think it's quite worthwhile to have some research on the Bretton Woods and the Euro currency market with a view of the global South. Well, there's kind of an interesting notion of a golden age of capitalism when it comes to Bretton Woods. So if you take a look at the global South perspective, they had a pretty much discontent over the workings and functions of Bretton Woods. This is why they gather around the UNCTAD. The very first meeting in 1964 had a pretty much great deal on their kind of dissatisfaction with the Bretton Woods, particularly the international monetary system did not link the aid program, because there was an interesting story in 1944 during the Bretton Woods negotiation. So, therefore, there was a 64 onwards, UNCTAD first and second, there were efforts calling by the global South for international monetary system to facilitate the economic development in global South. When their efforts were frustrated by the politics of advanced countries,
thank you,
like BIS members, and they turned to the Euro currency market.
Can I
Thank you,
follow
Seung
up
Woo.
just one quickly on
Sure.
that, Adam?
Sure.
So, I mean, this is a fascinating exchange. I think it will be interesting to many people. That
Super interesting.
So the new international economic order, remember, comes in 1974. The demands for a Bretton Woods for the global South. Okay, so this is all happening right at that moment. Right at that moment. It's in fact, I think. It is, and remember that the IMF in the 1950s had nothing to do because the United States was dealing with Europe, and so they dealt with the global South. So this story of the evolution of the IMF is part of this as well. So this is the real history of the euro-dollar market.
Indeed. Thank you. Bruce, your hand is raised also. Do you have a question or comment, please?
Hi, Seung Woo. I think that was a really great presentation. Thank you very much. I was curious if you've read Joe Studwell's book about how Asia works, where he goes into some of the details of Korea, Japan, and Taiwan, and how they were so different from many of the other developing countries in that time period, and sort of in some respects didn't follow the advice of the so-called experts from the West, did things their own way, and obviously worked out so much better. And if you have an opinion on his book.
Yeah, so quite interestingly, for those countries who did not exactly follow the US administration's instruction or advice, made a success. And I think there was kind of interesting story where we can understand is the US policy, which the Rose-Tone policy, but there was another factor of anti-inflation in the US administration, because they have a historical understanding what happens with inflation, as in the case of Germany. That was kind of in the mindset of the US officials. So they trying to entice economic growth and development, but at the same time, they want to make sure that the low inflation should be maintained. I think in that point have made a divergence, but it's not really proven. But while recently I'm in Korea because of COVID, the issue, and I'm doing the research for this project. So I made a great exchange of idea with the Korean economic historians, and they pointed out that the other countries embraced the anti-inflation recommendation by the US administration had a relative less success in maneuvering, making the economic growth.
Okay, thank you. We have also Anush and Karen's. Please try to be very briefly because of the lack of time. Anush?
No, yeah, thanks. Just very briefly, it was super fascinating paper. I'm very interested in the idea that this interaction with the Eurodollar market then becomes the first installation of neoliberalism. And I don't know if you can expand on that, because I wonder if that actually cuts against the new economic order and everything that ends up happening. In other words, the Eurodollar market looks like it's going to become a source of flows to the global South, but ends up becoming something else. It ends up becoming a transmission mechanism for a rather restrained order. And of course, Korea is amongst those countries that violates neoliberal protocols or holds them off for a long time, and therefore succeeds, whereas other countries succumb, and how that then links to Kindleberger's view and so on. But super interesting. Thank you.
Thank you, Anush. Karen? Okay.
Thank
You are muted, Karen. You are muted.
I have a quick question. Do you see any correlation with development of Korean, South Korean industry in terms of its direction? Is it going more? It strikes me that we actually have had South Korean products in Europe for as long as I can remember. So I'm thinking, was there a correlation with how it developed its industry and its trade relations too? Or are these two things completely independent?
There was a disconnection from my side, so could you repeat the question again? I'm sorry.
Okay, sorry,
yeah,
Karen.
I want to know if there's any.
Karen, excuse me. Can you please send your question in the chat, and
Okay.
Sengwu, can you please reply to the chat her? And now let me.
And can I add a comment on the previous comment?
Yes.
Oh, well, yeah. So I have a kind of, it'll be very interesting to compare those technocrats in South Korean government with the Chicago boys in Chile, and then how those officials in the middle. Well, when it comes to neoliberal, they're kind of a Friedmans, big thinkers, and then there was a politicians. But we can kind of think about those technocrats, bureaucrats' role in disseminating the neoliberals. I mean, in case of South Korea, they imported the neoliberal ideas from their education.
Okay, thank you, and thank you for your very interesting presentation. And let me ask Kainaat Bhaskar from FKCCI, which is Federation of Karnataka Chamber of Commerce and Industry, if I know well, from Bengaluru, India. Kainaat, can you please hold your presentation?
Yeah. Seung Woo, finish your.
Oh, sorry.
Okay. Okay. So, so what I've done in this paper is I've analyzed the Asian crisis through the money view lens, and I've focused on transitioning financial systems within the Asian crisis. Before I begin, two things. Firstly, this paper was written a year ago where I did not have enough basic clarity to really get my point across. So it's a little messy. I plan on revising it. And secondly, this was a 10,000 word dissertation. So in order to cover everything, I've touched upon everything very, very briefly. Okay, to begin with, we should have a small background on the Asian crisis. So starting from the 80s, there were Southeast Asian economies which were growing at a very fast pace, including Japan, Thailand, Indonesia, Malaysia, South Korea, a bunch of others. This paper is based on Thailand, where the crisis originated. So these guys favored export-led growth and low international dependence. Their nominal and real GDP was booming, and they were prospering in social, economic ways as well. This ultimately attracted outsiders like the US, which began pumping money into Southeast Asia. And this large inflow of FDI was aided by financial liberalization and by other international developments like Plaza Accord, which meant that Japan was also funneling money into Southeast Asia. So this rapid inflow of capital reinforced the growth that was happening and created a cycle between the two, which is what inevitably contributed to the crisis in large part. The core problem was that most of these economies were structurally deficient. They had unhealthy banking practices, weak institutions, an ill-functioning central bank, standard structural problems. In short, they were not prepared for the influx of foreign capital or for the influx of growth that they were experiencing. Now, in the 90s, when the US began raising its interest rates, global trade dynamics shifted and capital flight ensued. Side by side, these countries were beginning to show signs of macroeconomic stress, and investors were growing wary. So, combined with the raising of interest rates in the US, investor confidence began spiraling, and that worsened the mounting pressure on these economies, but also especially in Thailand. So then, in July 97, the Bank of Thailand was forced to float the Thai baht. Prior to this, there had been a fixed exchange rate regime in Thailand and in most of these other concerned countries. But after multiple speculative attacks, Thai baht was forced and contagion spread, and all these fixed currencies were floated in a series of devaluations. Now, in all of this, there was a very important role played by the fixed exchange rate. Firstly, maintaining the peg sent the Bank of Thailand into a very severe current deficit and its horribly low reserves eroded its credibility. Second, with the baht not depreciating as it should have, export performance became volatile, which is what Thailand depended on. And most importantly, a fixed peg eliminated currency risk, which fostered a gross underestimation of risk without any hedges. So this paper is essentially a theoretical epistemological kind of stuff. The Asian crisis is essentially a twin crisis, which is a simultaneous banking and currency crisis, which are explained by third generation models. And they argue the prevalence of moral hazard, of balance sheet mismatches, of asset bubbles, liquidity risk, too big to fail philosophies. So the theoretical structure I have constructed combines third gen models with aspects of money view. Important to note is that the money view would it would be applicable to developing economies only partly, if at all, because these economies do not have the sophisticated fundamentals required for the globalized market-based system, which money view talks about. In one of his papers, Professor Perry has mentioned that the Asian crisis cannot, like money view cannot be used for the Asian crisis, and he's correct. But I do feel that some points which money view makes are pretty good at explaining some very fundamental parts of the Asian crisis. Lastly, I have incorporated heterogeneous agents into my structure to highlight that in the context of quantitative modeling, this crisis would be better served with heterogeneous entities due to varying behavior. My primary objective in this paper was to stress on the disequilibrium created in the economy, structured like a bank-based system, but functioning like a market-based system. And I'll argue that this is the primary cause of the crisis. So the first part of my paper identified structural weaknesses. The most prominent one was the excessive amount of leverage in Thailand. The Thai banking system was operating on an extremely flat pyramid within the hierarchy of money. By June 1997, the commercial banks of Thailand had almost 6 million baht worth of liabilities in excess of assets. Secondly, there was a weak central bank. The money view states the need for a strong central bank as a prerequisite for the stable functioning of the evolving global financial system. Bank of Thailand eventually failed to act as both lender and dealer of last resort because of its own weak position. Years of crony capitalism and moral hazard had led to the banking system believing BOT to be a free-for-all safety net, which the latter only encouraged through promises and guarantees and all of that. Also, in order to be a monetary stronghold, a central bank needs to be extremely well capitalized. But as the fixed peg got harder to maintain, BOT's reserves got dangerously low. Thirdly, the banking system had an excessive risk appetite. So market-based systems operate with modern finance, which includes advanced instruments, derivatives, hedging, a lot of stuff. Thailand was venturing into this, but very regrettably, the one practice was not touching upon was hedging, despite the multiple forms of risk it was facing. Their risk management practices, very important to note, they were primarily collateral-based and appropriate for a bank-based system, and they were also extremely insufficient. Lastly, there were inefficient markets. The Thai banking system had an appalling lack of dealers, which posed problems on multiple accounts. Asset bubbles got bigger with no one to absorb that excess liquidity. Information asymmetry and inefficiency was widespread, which only contributed to the net of moral hazard. Moreover, dealers encourage markets for derivatives. And had the Thai banking system had a dealer institution, maybe the appropriate hedging practices would have been in place, even if not incentivized by risk management. Secondly, I wanted to highlight the actions of agents in this transitioning system. So Thailand was in a pretty unique position, right? Sort of a bank-based system, sort of a market-based system. So its agents were also behaving in very unique ways, and their actions were assortments of developing and market-based market-based characteristics. So the three important agents were commercial banks, central banks, and foreign lenders. So regarding commercial banks, MoneyView has defined three core facets of the shadow banking system, namely maturity intermediation, global connectivity, and derivatives outside the existing depository framework. Plus, the MoneyView shadow bank also has an immature liquidity backstop with no structural foolproof backing. The Thai banking system fulfills 2 out of 3 of the main criteria. Plus, it also had an immature liquidity backstop. The only difference here, between the MoneyView shadow bank and Thai banking system shadow banks were that Thai banks had a definite backstop because they had a weak monetary authority, not because their backstops were present in the rest of the system. But the bottom line was they did not have the kind of backstop they required, which then leads us to question if the central bank's insufficient presence in the banking sector contributed to creating a shadow banking environment and contributed to the commercial banks eventually functioning as quasi shadow banks. Secondly, regarding the central bank. So Professor Perry has underlined 3 primary principles, right? There's the dealer of last resort, which is that you provide market liquidity. There is Badgett's thumb rule, that is you deal in securities at a wide spread around the market, around the would-be market price. And there is the de-emphasizing of too big to fail. That is, you prioritize good securities without spotlighting institutions as too big to fail. So the issue here is not that the Bank of Thailand behaved in these ways, it is that it did not when it needed to. So it essentially was not functioning the way a central bank should function in a market-based system at all. Lastly, there were the foreign lenders. So a shadow banking system is inherently vulnerable to changes in sensitivity of information, which refers to how much information an asset holder needs about that asset to feel confident about it. So within the Asian crisis, the bank runs can be described as a change in information sensitivity, with Thai assets going from informationally insensitive, that is, they were backed by just a bunch of guarantees, to informationally sensitive, where those very guarantees now failed to make asset holders confident. Normally, deposit insurance or other similar methods can prevent banks from falling prey to the pitfalls of changes in information sensitivity, but Thailand did not have any, which enabled foreign lenders to engage in bank runs. Lastly, we have agent expectations and their significance. So Thailand was trapped in the impossible trilemma, which Nathalie mentioned, and had ultimately sacrificed monetary independence. And the many agents involved in Thailand were able to act the way they wanted, with no regulatory authority to really channel all of that in a safe manner. The crisis saw multiple agents connected through the Thai banking system and the fixed exchange rate, the latter of which created expectations on most of their parts that had a critical role to play in the unfolding of the crisis. So commercial banks, who acted as quasi-shadow banks, the primary source of difference between MoneyView's extension to the Asian crisis as opposed to the subprime crisis is the inclusion of the fixed exchange rate. The fixedness of the Thai baht created an expectation of safety, something which I mentioned in my introduction. And the risk-free stability only incentivized them to engage in market-based functioning and the whole quasi-shadow banking. And they were, in fact, primarily spurred on by moral hazard in the system. Secondly, there were foreign lenders. Now, these group of agents had a twin set of expectations based on the pegged Thai baht, with both of them dealing in equally intense impact. In the initial stages, FX stability created expectations of low risk, and in the later stages, declining macroeconomic fundamentals overtoned those very expectations into negative sentiment. So these bond lenders initiated capital flow based on a set of expectations and initiated its outflow based on yet another set of expectations. And these shifts in expectations were caused by one common thread, which is sensitivity to information that I mentioned in bank runs. Lastly, there were speculators. Speculators were highly powerful with no active presence or role. They were not actively contributing to the financial system. But these agents are the ones which triggered the crisis because they could see the stress on the economy, they could see the stress on the Thai baht, and they decided to capitalize on it. They speculated on it, and eventually it was floated. So from this analysis, there are a few lessons which emerging economies can learn for how to navigate entering the contemporary globalized financial system. Firstly, there are dealer institutions. Any market setting out to establish a market-based system must have a sufficiently well-performing dealer structure. Governments need to establish adequate infrastructural support and adjusted regulatory provisions for dealer institutions as a prerequisite to engaging in market-based systems. By extension, these dealers need to maintain market funding and must remain adequately capitalized. So not only should governments focus on setting up dealer institutions, they should also ensure that these dealers stay well funded at all times. Deriving from that, there is the dealer of last resort. So after the crisis, the liquidity reforms that were implemented in Thailand were bank-oriented and not market-oriented. So the IMF had stepped in with a bunch of bailouts, and the IMF operated as lender, but no one acted as dealer, even though the Thai market needed one. Thus, there is the important fact to consider that in 1997, unconventional monetary policies were exactly that. They were unconventional. Nobody would have probably thought about using them, which is possibly an indicator of a lack of readiness for embracing the market basis. So, in short, emerging markets need to prioritize a robust central bank capable, and they need to stress on the dealer of last resort function, which is not explicitly understood. Third, there is the modern finance. Emerging markets should ideally have a large, stable, well-capitalized derivatives market, and at least appropriate hedges can be made. Plus, with governments should ideally be actively involved with derivative markets through regulatory oversight and the like, with maybe like an option with balance between restrictions and safeguards. Lastly, there is the question of insurance. So deposit and credit insurance has proven to be an effective method of deterring bank runs, and it's a valuable practice for emerging markets. Thailand's concerned organization, the Financial Institution for Development Finance, began insuring creditors and depositors only after the crisis, which does not hold any value at that point. So establishing both of these mechanisms while entering the global financial system is an important exercise. So this is a checklist of sorts which emerging markets can utilize while focusing on agent behavior within this checklist and tailoring policies according to agent behavior in their own markets. The importance of having a transitioning checklist for emerging markets is relevant even today, as is the importance of recognizing that transitionary phase and where they stand in it. There are two very prominent instances here of agents acting incorrectly due to a failure to gauge that transitionary phase and to gauge that the existence of that disequilibrium and the extent of that disequilibrium. So the first of these instances is the banking sector using only collateral-based hedging practices, which are not suitable for a market-based system. And secondly, there is that of the IMF offering only bank-oriented solutions. So I've not been able to go really deeply into what I think I should have done, but I intend to when I revise the paper. But yes, offering bank-oriented solutions to a structure means that they only looked at how this banking system is structured, which does not exactly solve the problem at hand as well as it should be. Lastly, so with the upcoming Fed rate hike, emerging markets stand to experience bouts of capital outflow and volatility. Especially countries like Brazil are considered to be at greater risk. In a post-COVID world, the effectiveness of monetary or fiscal policies in managing such events is very restricted, and therefore equipping financial markets with the knowledge to understand their space in the global financial market is important for long-term stability. Yeah, thank you.
Thank you. Thank you, Kainaat. Seung Woo, do you have anything to discuss?
Yeah, thanks for the interesting paper. And I have a very simple one. So it seems to me that Thailand was not ready for what was going on in the international finance. But given the role of the national government in the making of economic development, I think I just want to ask a very simple question. How do you assess the role of the government in this crisis and aftermath words? And if you pointed out the defects, mistake, or the not read, sorry, let me rephrase it. So in your paper, you're seeing the system was not really ready for the international finance, but what happened afterwards? In case of South Korea, after we opened everything, give a central government, liberalized finance transition, everything, there were kind of social costs because the state kind of left their hands over all the social security issues and then opened the economy in itself, and there was kind of a huge disorder and then political problems as well. Do you still believe that those kind of matters that you recommend should be introduced even after all those social costs? I'm sorry to be political, but it usually reminds you of the what happened in South Korea after 1998. So that's a very simple question. Thank you. I think I have that one only.
Thank you. Kainaat?
So I don't have particular recommendations for how the fiscal authority should be involved here, because my focus over here was more on central banks and how the central bank should be interacting in the market. But that is a good question, and I think when I revise the paper, I will look into that, because I've not done much reading or research about the political side of things, about how the government got involved, mostly about the central bank. But I'll look into this. It's an interesting perspective.
Thank you.
Yeah.
Thank you. Thank you. Thank you, Nathalie Marins, Seung Woo Kim, Kainaat Bhaskar. It was a very nice session. I was glad to be the moderator.